Welcome to the Rose Show podcast.
Welcome to Macro Markets and Investing with Prometheus Research. Thank you so much for joining us this evening. We hope to make this space educational and lots of fun. Quick disclaimer, please do not construe this as investment or financial advice. I'm Rosanna, your host, your co-host actually, and I'm here with Aahan, founder of Prometheus Research, a research service that makes institutional quality insights and provides macro analysis that is insightful and actionable. Prometheus accomplishes this by dissecting every piece of macro data in the US and then uses a rules-based quantitative approach to translate this analysis into portfolios. It's very impressive. I'm impressed. Accordingly, in this space this evening, we will be discussing macro analysis that is insightful and actionable and what it means for the markets and investing for now and in the future. I'm Rosanna, your host, currently CEO of International Manufacturing Warehousing e-commerce business, and also CIO of an investment holding company. I've been a serial entrepreneur, an equities and real estate investor for over 25 years, also an options trader, and I'm always focused on generating passive income. And just as in Greek mythology, Prometheus defied the gods by stealing fire from them and giving it to humanity. Tonight, Prometheus Research takes alpha from the institutions and gives it to the people, all of us. So let's begin. Aahan, please tell us about Prometheus Research and its unique approach.
Yeah, hey, thank you for that kind introduction, and I can only endorse you as kindly as you've endorsed me. With regards to Prometheus, what we do is a little bit different from what you will see typically on Wall Street and Wall Street affiliated, right? So what we do is we go out and we spend all of our time trying to understand the linkages in the economy to get a really good sense of what is happening both today and what happens to the economy over time, to be able to assess what are the mechanics that drive the economic cycle. We spend a lot of time doing this, both in current context and then stress testing our understanding over time. And then we take the most durable components of our study and we try to systematize that. And what I mean by that is we construct a rules-based approach to the things that we learn to basically create a set of rules that allow us to create portfolio solutions. And we have a variety of portfolio solutions, but this year in particular, we have been talking a lot about our alpha strategy, which is particularly important this year. And that's kind of, the 50,000-foot view of how we do things. We don't really look for, one-off analysis. We're trying to find and create things that are durable so that, investors that are using our services have something durable and reliable as a starting point. So what you would want to do beyond what we provide you is really a personal choice and depends on your circumstances. But what we will always give you is we'll give you a very good base of things that are supported and durable over time.
Wonderful. Thank you. I love that. It's like Prometheus figures out how stuff works based on the understanding the underlying mechanisms rather than just analyzing data like most firms do, correct?
Right. And I think that that's really what allows these things to stand the test of time. One of the things that we've done is we've tested our strategies through high inflationary periods. We've tested our strategies through deflationary, disinflationary, like any situation that you could possibly imagine. We've gone out and tested what works, what doesn't, how do the linkages work, so that we have a really good understanding of the mechanics that drive the economic cycle and asset markets. And that's really what creates durability, right? Having a really good sense of what are the linkages that are creating money for you, and whom are you potentially, if you're trying to generate alpha, taking money from. And I think that that's really what the understanding the mechanisms comes down to. Because if you can't tell me why you're making money, that's a very big problem. And I think that it's a pervasive problem that people very often, try to be overly practical in the industry, and they want, to get the next trade out or the next position out so fast. They're not always certain of what it is that's creating those opportunities. So they're just as blindsided when the risks come calling.
Excellent. Thank you so much. Before we get into the macro research, can you please explain to all of us the backdrop of monetary contracts and how we got here?
Yeah, I think it's important to always start with a framework. So the way we look at the world is that there are essentially two systems, right? You have a monetary system and you have a real economy, right? And these two things come together to create the economy that we know and operate in, right? Now, what is that these two systems are pretty different. So the real economy is what people see all around them, which is just labor and capital, and that includes things like intangibles and goodwill and intangible assets, right? But these are all real resources, and there's the key thing about these real resources is there's a finite amount of them and a finite capacity to grow them. The second leg of the economy is the monetary system. And the monetary system, it might sound like a complex thing. It's not really all that complex. What the monetary system is just a collection of social contracts between various parties. So, the most common, social contract that we're used to is the contract between the government and the public, which is just money, right? And there are various different forms of money. Now, you can have contracts between lenders and borrowers, which is credit. The thing about these contracts, right, is that they can expand and contract at a rate much faster than the underlying real capacity can. So if you think about labor can only expand as fast as our population, can reproduce, and there's a very real limit to that. But when we look at, how fast credit can expand, especially as we've seen over the last years, the capacity for credit creation to grow is much more immense, and it really just depends on what we as a collective civilization decide is the pace that is appropriate. The issue is that there's a strong link between what these monetary contracts are supposed to represent and the real economy. And what happens over the course of the economic cycle is that these two things can get far out of whack sometimes. And when we get overextended in one direction or the other, you tend to have very large contractions, usually happening in the monetary system, either to the upside or the downside. And that's really what the business cycle is.
I love this. It's a graduate level macro course. I love this. This is great stuff. It's fascinating. And that helps give the backdrop for the macro and what's going on in the economy. I thank you for that, Aahan.
Right. So
now,
maybe sorry to cut you off. Maybe we can put it.
No, it's okay. Please do.
We can put it into context today, right?
Yes, please do.
And, if people were here on our previous spaces, they probably heard something similar. But I think it's really important to kind of reiterate this. What happened during COVID was we basically had the real economy, so labor, capital, all the intangibles, all the things, kind of just shut off overnight because we had lockdowns, quarantines, all these things. But the government came in and decided to create a large amount of monetary stimulus. Now, there are many different ways they could have done this, but the ways they chose were to essentially go out and create income for the private sector. Now, in a usual situation, income and production always move hand in hand. But in this particular case, you had no increase in production whatsoever. In fact, you had a very large contraction in production and a very large impulse of income. What this does is it creates a sort of imbalance, right? And you would think that the ability of production to catch up over time would make up for it. But the issue that we have is that the government's injections of these monetary assets into the private sector create highly liquid assets. These liquid assets, the best way to think about them is that they're just cash. Now, the fantastic property of cash and also the difficulty of cash, which is creating the situation we have today, is that cash at all times commands par, right? So if I come to you, Rosanna, and I were to say, I have $100, what would you give me back? You'd probably break it into tens and give me back the $100. And this is really the problem that we're facing today, where we need to re-equilibrate the balance between production and the amount of liquidity out there. So that can come in one of two ways. You can either have the amount of money out there contracted, right? But that is not possible given that all money usually commands par. The only other way is to erode the value of money. And that process is called inflation. And that's what we're living through now.
I love that. Thank you so much. Yeah, we have monetary inflation. I love how you make it so clear for everyone, and that they infused money into personal incomes and the economy, whether it was stimulus, PPP loans, and there was no production in labor. So we had that excess money, and that's going to take time to erode that. So that makes it so simple and clear for everyone. Thank you. Now, your research points out something very important, and I think everyone needs to be aware of this, that monetary policy likely needs to be tighter if Fed wants to tame inflation. I love your model that demonstrates that interest rates need to be higher relative to inflation to catalyze lower future inflation. Can you please explain that concept for all of us?
Yeah, absolutely. So I think before we get into the exact numbers and whatnot, I think it's important for anybody listening here to understand that we want to avoid any sense of false rigor. So I don't think that any particular number is the right one. Like, I can't tell you that 5.5% is the exact right rate to get inflation down. It would be foolhardy for me to try and do that. But that being said, we can look to history to kind of map what is appropriate in terms of creating future tightening. So let's take a step back. So what do you usually need to create a contraction in future GDP and future inflation, right? What you essentially have at a 50,000 foot level is that you need the base rate of interest rates, so the very base rate of borrowing, which is usually set by the discount rate that the Fed provides to the rest of the economy, to be somewhere at par with nominal spending levels. So that's just nominal GDP. Nominal GDP has two components. There's the inflation component, and then there's the real GDP component. Now, what you've usually needed is to create lower inflation in the future. You have needed interest rates to at least match, if not exceed, nominal spending growth. That's nominal GDP. Now, during periods of contraction or like stagflation, like where we're approaching, almost all of nominal GDP, if not all of it, is just inflation. So, to kind of to be a little reductionistic, what you've needed interest rates to be above your rate of inflation. Now, you can look at this from the perspective of PCE or CPI. You will still roughly land at about the same place because those two variables are extremely correlated and have maybe slightly different levels. What the Fed has needed to do in past cycles to be able to cause lower future inflation is to be able to raise interest rates above the current rate of inflation. So we're currently sitting at about, let's call it 8.5% on CPI and between 6 and 7% on PCE. Currently, we're sitting on interest rates at about 3.5%. And the path that's laid out in markets is that we get to about 4.8% on Fed funds. Now, that gap is still immensely large relative to history. So if we go and look at all of the cycles where the Fed had to break inflation, they had to raise rates 2% in excess of CPI, which is pretty high. Now, if we go and we say there are two ways that this can be done. This can either be done through CPI coming down, or it can be through rates going up, right? And looking through history to get a sense of where, how that's likely to transpire, what we see is more often than not, it's the rate part that has to go up to match CPI rather than CPI that ends up coming down. And a lot of that has to do with inflation entrenchment. So once you enter these kind of inflationary spirals, without an appropriate catalyst to cause the outcome that you require, you're very unlikely to actually get the deceleration, to be strong enough to achieve your objectives as the Fed. So I think that what a lot of people are hoping for and expecting is this likely path of, CPI is going to mean revert, and every cycle is different. So there's very much a possibility that we do have some amount of mean reversion of CPI. So for example, on CPI, Prometheus has trend CPI at about 6.5%, but that's still well in excess of the projected path for interest rates. And why this is important, right? It's not just about forecasting inflation. It's important because if this is indeed true and we need to go higher than is currently expected, you very much have a situation where bonds don't catch a bid and equities continue to suffer, which creates a whole host of issues for the asset management and asset allocation community.
Excellent. Thank you so much. That brings into light the situation that we're undergoing right now. While everyone's hoping for a pivot or an end to the rate hikes, it seems that the best case is to continue the hikes to help bring down this inflation. So that makes sense, and I appreciate your explanation. You talk about stagflationary nominal growth, and we noticed that at our business and our manufacturing business. Revenues are held up more by inflation and increased prices than higher output and volume. Meanwhile, cost of goods sold and operating expenses are much higher, about 20 to 30% higher. There you have margins compressed. Productivity is down as well, and you speak about that in your wonderful Substack. And everyone, please make sure you're subscribed to Prometheus Research Substack. It's free, and it's one of the best macro you can read. I love it. And productivity is down. There's less output per every dollar. We need more capital to produce each output. And of course, there's been a change in the worker as well through the whole COVID and everything. But when companies reinvest their profits, the real output produced for every nominal dollar invested keeps decreasing. And I got that quote directly from your research. Could you explain that process a little bit, please?
Yeah. So I think we had a conversation about this a while ago, but we as economic actors in the economy, we live in a nominal world. We're nominal targeters, we're nominal spenders. So the current dynamic is a situation where nominal activity still is extremely elevated. So you're talking about something between 6 and 9% nominal activity, but on a real basis, and we have a GDP nowcast, which updated I think last week, which has us at approximately 1% real GDP. Now, the issue with this entire dynamic is that more and more you have inflation eating into corporate profitability. And I think that what a lot of the street today doesn't realize is that while profits are quoted in nominal terms, their utility is in real terms. So what do I mean by that? The purpose of corporate profits is to decrease your real cost of capital in the future. That is the reason that you have any residual business savings. Otherwise, they would all just be returned to, investors. Now, when I go out and I try to reinvest my corporate profits in a period of very heightened inflation where I have negative real corporate profits, the per unit of dollars spent of my corporate profits now, I get less and less input. So, say I make $100, I go out and I spend it, I get less incremental units of production than I did last year. And what that does is it creates a self-reinforcing spiral where I keep trying to meet my profitability targets through price increases because nominal activity is healthy enough to support that, but my real output continues to decline. As a result, you have this trudging lower in real economic activity. Now, this comes back to what you started with, which is this idea that we have been talking about for I don't know how long now, which is that we are in an environment of stagflationary nominal growth. And what that just means is that the inflation component of nominal growth is dominant, right? And that's a very insidious kind of part of the cycle, because when you have nominal activity compounding at a rate that just isn't supported by real activity continues to get more and more under pressure as nominal activity continues to eat more and more of the pie. Said differently, this is a dynamic that we've seen a lot in history, contrary to what a lot of people think. But we've seen it in the form of what you would call a late cycle. This is a pre-recessionary period in most business cycles. The difference today is just the magnitude that we're seeing.
Wow. Thank you. Yeah, it seems to be a dilution of value. And that's what I call it, because you're getting less. For every input, you're getting less output. And that's very concerning. We had the PMI this past week, and it clearly shows a decline in manufacturing and nominal business activity. Therefore, we can expect more downside in economic activity, which will create more headwinds for equities and credit. Aahan, can you please tell us what type of headwinds we may be expecting?
Yeah, sure. So I think that just to kind of frame the PMI discussion. So what for those who aren't too familiar with PMIs are basically they're surveys where you go out to purchasing managers who are essentially people who just manage the process of inventory management relative to new orders for various manufacturing companies, and you ask them what they're seeing on the ground, and those survey responses are totaled, and you get a very good idea of contemporaneous business activity. Now, the use of these surveys is that they typically tend to coincide with what business managers are seeing on the ground, which also kind of informs their future investment decisions, which also is one of the largest sources of profitability. When we look at what PMIs in aggregate are telling us, they are painting a very poor picture for corporate profitability. Now, we have two differences. We have multiple different systems that run to give us an idea of the corporate profit cycle. And what we're seeing is, while yes, the PMI data is painting a very negative picture, nominal activity still kind of remains elevated. But what the Fed is doing is causing another set of headwinds, right? And how that works is the Fed goes out and hikes interest rates, which contemporaneously it causes a decline in asset prices. Now, if you think about asset prices, they're just somebody else's liabilities. But you have a negative net worth effect, right? Which is weighing on corporations alongside what in future will be an increased cost of borrowing, alongside a very heightened level of inflation and poor real profitability. The combination of these things are highly unlikely to be conducive to a lot of business output in the future. Now, how that plays out, we can kind of get into all of that and the business dynamics, but the picture is not a strong one. So, to relate this a little bit to markets, I think that there still remains a bias in equity markets. So, if we go and look at equity markets today and we decompose kind of what could have prospectively driven the contraction in equity markets, not a lot of it has actually come from equities discounting significantly lower earnings. Earnings have come down, but they're by no means close to contractionary territory by the market's expectations. And if these pressures continue to build the way they are, the next leg lower from equity markets will probably be from lower earnings and such.
Yes, I agree. I think earnings are under pressure between rising rates, which further slows growth, diminished future valuations, margins being compressed. Plus, we see manufacturing has slowed significantly. New orders are down. It's contracting. And those are all forward indicator for earnings, as you said. So it's very concerning. There's a contraction going on in the economy. Now, I'll quickly reference our business, our manufacturing business, which is business to business. We've seen similar patterns since late last year and Q1 this year. We're on the forefront of all this. And so we experience it even before the data is revealed. There are some data lags that go on. So I will briefly share with you. We've noticed that there are several industries that have shown stronger growth compared to the rest. Machinery, transportation, equipment, food, beverage, and computer and electronic products. And those industries are actually the ones that have been making more purchases of equipment lately, as well as a few others. And I'll briefly go into this. There's a changing rotation, like a rotating of sectors and customers who are buying. We have seen that the smaller businesses can be more sensitive to the rise in cost of capital and debt for CapEx expansion and maintaining cash flows while margins are compressed. They're also faced with higher costs of production and labor. So we're noticing that there's more sales to larger companies, publicly traded, and we have quite a few publicly traded companies as customers. Governments, US, Canadian, actually, we've been selling to different parts of the government, and Fortune 500 companies. They tend to be less sensitive to the rise in costs. And plus, some of these industries are less elastic and have sustained growth. The sectors tend to be more consumer staples, industrials, food, medical, some services, and industrials. We've been selling a lot of equipment to the aerospace, turbine engines, metal molding and casting, polymers, lithium metal anodes. And so it's very interesting to see the shift in the type of businesses who are buying this equipment, and they're making rather large purchases as well. So, and that's what we've noticed. And beauty sells. I'll tell you, I have a lot of cosmetic companies still buying equipment. So no matter what type of economy we're in, people want to be beautiful. And then I've noticed a huge difference in foreign orders due to the stronger dollar. It's actually quite interesting. Foreign orders comprise about 30% of our yearly sales. During 2008, it rose to about 50%. Now, about 5% this year. And the ones that order tend to be more defense companies or governments. So once again, we have a huge reduction in foreign orders due to the strong dollar. It's just really interesting to see it from the business side in addition to the data. So very interesting. And lastly, during COVID, we saw a huge increase in sales to startups, smaller businesses, discretionary industries. More goods were produced during the pandemic. People were buying more goods. Now they've shifted to more services. And we saw that with the companies that we sold equipment to. A lot of companies were buying for candle making, soap making, and consumables. So it's just interesting how it changes. And we see that as these trends are going on. So just want to add a little 2 cents there. What was the ISM data? Was it in line with what your systems were expecting?
So two-pronged answer. We do two different things at Prometheus, right? So we have a set of indicators that kind of give us the trajectory of what the likely economic data is going to be over the next few months, right? So we basically are estimating what the pressures are based on our systematic process, what the trajectory is over the course of the cycle. And from that perspective, we've probably been bearish starting in January on growth prospects, and you've kind of had that play out, and that's still playing out. So from that perspective, we've just been expecting a lower and lower trend in PMIs in general. Now we overlay that with a risk management process of forecasting every single print that we think is relevant to what we're doing. And when it came to the ISM, we actually had it as at a very modest acceleration, but for us, it was really a coin flip. It was a 50-50. It wasn't like a very big probability. And we actually went into the event with shorts on. So, shorting equities and things like that. And for us, it was very much about, we could have a very, very small kind of counter trend move in the ISM based off, a bunch of indicators that we look at to estimate, ISM on a print by print basis. Now, on a forward-looking basis, right? I think that this dynamic in the business sector is really important. So, what you're seeing is that let's start with the consumer, right? So we talked about how you have lower real profitability, and that lower real profit. Now you have to remember that when you have these lower real spending amounts, right? So no lower real sales, which is what businesses are actually on a real basis. They're in contraction. They've been in contraction for a while. Now these lower real sales, they translate into lower real incomes for consumers, right? And what we're seeing is that that's resulting in lower real spending, right? So if we go out and we track about 16 different segments of the consumer economy, which make up the aggregate of the consumer economy, 4 of those are already in contraction. Now, we're not seeing that fully translate into weaker business activity yet. But a lot of that is because, well, businesses at the end of the day operate on nominal terms. The addition of when we add to this the fact that we have what typically happens during inflationary periods, which is we have very, very large inventory builds, right? So if we actually go and look at, I think on principle first, we have to establish that one person's sales are another person's inventories. So I can actually have a release valve where, in the event that I don't actually manage to move my goods to my consumers, I can just add them to my inventories. And that's kind of what you're having today. So you actually have contractions in real demand for certain areas, but you still have very large inventory build. The reason I can build so much inventory right now is because during inflationary periods, my inventories are not penalized. So as a result, companies can continue to increase their inventories, and that in aggregate pads sales across the business sector. Now, there's clearly a very strong limit to that because there's only so much space for me to add inventory. So for example, if I use the automobile example, automobiles in terms of real demand at the consumer level, we're not moving more units, but businesses, so dealers, continue to purchase more automobiles because what we know is that if they purchase an automobile, they can still move it about 6 months from now at a higher price. Now, obviously, there's only so much space in my lot. Now, what that will end up being, and what we're seeing the initial stage of, is eventually that will translate into lower new orders. So new orders for manufacturing goods are already on a real basis in contraction, which is very much at odds with production. Now, this combination of things, it can't stand for very long. And what that does is it sets you up for a period of time where you're going to have lower production. That lower production, we already have lower new orders. When we have lower production, eventually you reach a point where you're not actually using so much capacity, so you don't need to employ so many people. And that's the point that we're going to get to, where you start having a contraction in the labor force. So I know we started this discussion with the ISM, but I think the ISM is just indicative of one part of what's happening in the business sector. And highlighting these dynamics is really important because this is the part that we're on. People often talk about leading indicators and lagging indicators, but I think that what people need to do is take a step back and realize that macro is not a hierarchy, it's a symphony. Right? So what we need to do is understand what the ensemble of economic indicators are telling us. And when we look at the economy through these lenses, what we're seeing is that the likely trajectory is towards lower levels of production, which will eventually mean lower levels of employment, the combination of which will result in negative real growth. So we're in what we call stagflationary nominal growth, right? But the pressures continue to build for us to transition to a period of outright stagflation.
Yes, thank you so much for bringing up the inventory issue, because that's a big issue with our manufacturing business. As you said in your research, excess production is finding its way into inventory build. And without sales growth, it is unsustainable. Agree completely. We see with our business, supply chain issues and delays are still present. Materials are in short supply and there's lead time growth. Regarding inventory, it's a balance. And it's a balance between maintaining higher inventories to avoid delays for order completion, and at the same time receiving bulk discounts and lower pricing in case of further increase in costs. So it's sort of an investment. And then at the same time, we want to balance that side with still keeping the accounts payable down, and then minimizing risk of those inventories building and then having to sell them at a lower price. There's uncertainty about future orders. We see real demand coming down. There's less purchasing power. So it's always a concern that not only is it going to be lower production and lower sales growth, but there's going to be lower real demand. And no one wants to keep inventory on hand anymore, it seems. And that line right there, I got directly from the PMI report. And that's exactly what I've been thinking. No one wants to keep inventory on hand because it is risky, but there's a balance. You want to avoid the lag and the delays in the supply chain, but you want to have enough, but you don't want to have too much. You know, even from my vendors just this past week, I get these emails that say, due to current market volatility, material pricing and lead times will be reviewed and possibly adjusted when required. Thank you for your patience and understanding. Now, is this entrenchment or is this really going on? Are they just thinking I'm going to accept this for the next year or two? Or is this really a concern? We don't know. But I will say, lower demand with rising inventory levels are concerning. So it is a balance. As demand softens, I'm hopeful that these issues should be overcome in these supply chain delays. However, it takes time. Aahan, can we speak about profits in nominal versus real basis?
Yeah, so I think that this is important for both, thinking about future trajectory of, economic growth, and also important as investors, right? So let's take one at a time. So, I think I outlined at the start, that profitability matters in terms of reducing your real cost of capital. Now, if you have extremely high inflation, and inflation to the extent that it's in excess of your profitability, all of your profitability is effectively useless in reducing your real cost of capital, because when you redeploy your capital, you essentially can't you can't invest in new productive assets on margin. You can't increase your output proportionally relative to where you could last year. And that's a really big problem, because it starts to drag more and more on output, and you given the amount of nominal income and spending that you have in the economy, you end up turning to price increases to make up the gap. That can happen only for so long. So what you end up having, where you have a situation of, you know negative real profitability, is that you have decreasing real output from businesses, which eventually will translate into, we should get into labor markets next. You have decreasing real output, which results in weaker labor markets eventually. So from an output perspective, real profitability being weak is just telling us that the next shoe to drop is going to be real GDP, right? So we're going to have a situation of contraction in real GDP, and we're slowly but surely heading in that direction. From an investment standpoint, this is really important too, because at the end of the day, whether you are investing to beat interest rates or you're investing to beat inflation, you are doing roughly the same thing. People typically look at the returns that they can get above cash, but cash is essentially one way of immunizing your inflation cost, right? There's no way I can really. There are some ways, but there's no way I can go out and immunize inflation in a portfolio, especially if I'm just buying equities. But I can try to look at cash as an alternative to eroding my real purchasing power. Now, when I have a situation where cash rates are rising and inflation is rising, my return stream that I have is much less valuable. And I think that that's the two pronged effect, right? That you basically in a slightly more a little bit more jargon type of way, you will have lower Sharpe ratios, and you will also have actual assets that are weaker. And it's overall, this situation of real profitability is not good for the companies. It's not good for GDP, and it's definitely not good for you being an investor and holding long assets.
Exactly. Thank you so much for explaining that. Very, very important concept. There's a huge disparity between the nominal versus real. And we can talk about that with wages as well. Nominal wages compared to real wages. And there's a big difference there. With this tightening liquidity, and as QT continues, your systems make a fantastic point with their estimates that the returns on assets relative to cash is negative. And your report said, quote, this environment increasingly favors those who can either move into cash entirely or have the opportunity to short assets. Can you please clarify? In layman's terms, is cash king?
Yeah, the short answer would be yes. But I think that there's a three-pronged kind of answer to this. When as investors today, depending on who you are and what you're trying to do, there's a hierarchy of things that you need to do. The first thing I think that is extremely important is to understand that so let's take a step back. What is this thing of tightening liquidity? Tightening liquidity is a situation where the base of liquid assets that are money-like assets, so things like bank deposits and things like treasury securities, treasury bills, and very short-term money market securities, things like that. Those things, when they begin to contract, essentially the fuel for future economic growth in terms of credit creation is contracting. And periods of time like today, they are not consistent with what the system is necessarily built for. Contracting liquidity and contracting monetary policy are just not consistent with long-term capital formation. We can't go through contracting liquidity ad infinitum. We can try to do it to recalibrate the system from time to time, but the entire system is built on a flow of funds from cash and cash-like assets into risk assets to create future production and growth, right? So when you enter a situation like today, you're essentially reversing that process. And that's extremely painful. And that's what we've seen in asset markets so far. What we've seen in asset markets is a pullback in liquidity, both financial liquidity and some amount we're trying to actually pull back real liquidity, but that's really hard, and which is leading to a disparity between CPI and asset price inflation. So the first thing that you need to realize as an investor, if you're a passive investor and you're investing for the long term kind of thing, you have to realize that yes, cash is king, and that you need to protect yourself from losing money before anything else, because compounding at a higher base is way more powerful than compounding nonstop with extremely large drawdowns. That's the first one. The second thing is that investors need to understand proper diversification. When I say diversification, I don't mean just owning 50 stocks instead of 10 stocks. Every asset is predisposed to do well in certain environments and do poorly in certain environments. The problem is that over the last 40 years, we've had basically one long environment which was the same, which is what we call disinflationary real growth, where growth was positive, productivity was good, and you had a secular decline in interest rates and inflation at the same time. As a result, there are two assets that love declining inflation. They're equities and they are bonds. These two assets love this environment. So as a result, if I paired those two things together, right, equities and bonds have opposing growth biases. So equities like it when growth is doing really well, real growth is really doing well, which is evident. And bonds do better when real growth is doing poorly because their fixed cash flows look more attractive during those periods. You combine those two and you basically have one big bet on that inflation and rates will continue to go lower. Now put that to today. What has happened? You've had the exact opposite, and it has been the most painful period in history for equities and bonds together. There used to be this idea that bonds will always diversify your risk for equities, but that was not a feature of the asset classes. It was a feature of the economic environment. So now, when what could be potentially a completely different economic environment for a sustained period of time. And what you need to be doing is going out and looking at alternatives. So what are the alternatives? There are more sophisticated alternatives, right? Like CTA trend followers and fancy things like that. But there are other alternatives in the form of gold and commodities that are also strong alternatives. You have things like TIPS, which are treasury inflation protected securities. All of these assets prefer environments where inflation is high or rising. And you need a balanced mix to protect yourself if you are a passive investor, right? So I think so to go back to the three things. So the first thing is you need to protect yourself and have higher cash. The second thing is if you're still passive investing, but you don't want to be in cash and you really think that risk assets are where you need to be, and there are plenty of reasons that should work. You need to be in a truly diversified set of assets. The third thing is if you are an alpha generator, and I want to stress this is very hard to do. If you're going out and trying to beat the market every year, it is one of the hardest things in the world to do. And if you're going and trying to really generate durable performance in an uncorrelated way, where you're basically saying, hey, I'm smarter than the market, I can make money, you need to be able to nimbly and in an extremely timely fashion short assets. So we have some short books of our own. This environment has been ideal, and this is not to honk my own horn or anything like toot my own horn, but I think that it's illustrative that our short book this year is up 20%, right? So this environment is extremely conducive to shorting, but you have to have the capital and the time to be able to do that. So I think these are the different levels of things for investors. So yes, cash is king, but the other things depending on who you are.
Perfect. Thank you so much. And you raised a good point there. And I think it's a very critical point for everyone to understand that returns are not a feature of asset class, but rather a feature of sample selection. Could you please explain that and then briefly explain how you are aligned regarding your asset class allocations?
Yeah, sure. So I think that what a lot of people, like I alluded to, have gone out and they are hoping that stocks and bonds will eventually come back, and they will at some point. So if I go and I 60-40 my stocks and bonds, and I air quotes I invest for the long term, I'll be okay. I think that is not the correct approach, because as I've outlined, the environment that we've been in for the last 4 decades has been extremely conducive to stocks and bonds doing well together. But if you go out and look through further history, right? So I think the period that is most educational is the period from, say, 1965 to about 1981, where you were in a secularly rising interest rate period. Stocks and bonds together in a portfolio generated about 4% on a nominal basis during a period where inflation averaged about 10%. So your real purchasing power would be completely ruined, and you wouldn't have even beaten cash. It would have been a very difficult environment for you to make money. Conversely, if you had a commodity portfolio during this time, you would have made about 20% a year. Now, the point of this exercise is not to go out and tell people to just buy commodities. I think it's for people to understand that the returns that you've seen on equities and treasuries together are not something to expect or to expect mean reversion to. I have seen so much information, on Twitter and elsewhere about how we will eventually revert to, more traditional dynamics. And I hope that works. I really do. I think what people need to prepare themselves for is the fact that maybe we don't. Right? So both from a passive investing standpoint and from an active investing standpoint, you have to be prepared for what if we do actually go into the 70s? What if we actually stay in a period of 5% inflation? And in those environments, it's highly unlikely that treasuries begin to, catch a bid again. So all of this is basically to say that what people are used to is not necessarily what has to happen again in the future. And we have to prepare for other outcomes, because otherwise you end up with years like today. So, to bring it to kind of our allocations, right? So we have different tiers of things that we do, but our alpha strategy in particular is what we would call our extremely active bets, right? So we rotate positions every week based off a whole bunch of signals that we get from economic data, financial market data. We have a whole regime system. We have a lot of stuff, and currently, for the last quarter, we've basically been short everything. We've been short everything except the dollar. So just to kind of give you the broad strokes of how we kind of went at the start of this year, we were pretty aggressive on commodities. Around Q2, we really started to get very bearish on equities because we started to see the dynamics emerge that we're seeing today. And since then, we've been short both equities and treasuries, depending intermittently on our timing signals. But I think that what you want to take away from what I'm talking about when it comes to the alpha strategy is not so much, oh, these are the positions to have for the next 6 months. It's that we have looked at long history of data and studied all these things and have a systematic process. And it is a rarity to go out and short absolutely every risk asset there is and be successful. We have a 54% hit ratio this year, which means that we have 54% of our trades have been positive. And that is not about telling everyone about performance. It is very much about telling people that this environment is not necessarily conducive to what people are used to doing.
Excellent. I know we always hear about the 60-40, 60% stocks, 40% bonds, and so forth, that whole mix. This time period is very different, and we need to approach it differently. And I love how you use that. It's a feature of sample selection rather than asset class, the returns. So thank you for explaining that. I always look at the positive in everything, and I'm a very positive person. I try to be, I think a positive mind creates a positive life. But these are opportunistic times, and that's how I see them. Bear markets and all these difficult times then birth great bull markets, and we will be great again. And I will discuss these opportunistic times from the business side. And they're opportunistic times for businesses and investors, remaining liquid to seize opportunities, as there will be many. So to me, holding cash is just remaining liquid. So when you see the opportunities, you're able to move forward on them. As you said, most real assets have negative expected returns in this current environment. That's true. And then you add inflation on top of that. Having cash and holding it for these opportunities and remaining liquid at least only has the inflation factor. We have been entrepreneurs and investors since pre-2000. I have to tell you from our experience, and we learn through experience, we learn through difficult times. It's through those times that we get stronger and we build character. And our business grew during 2008. That was a very difficult time in our economy. And during that time, we were very small and we didn't have much manufacturing. But during that contraction and that whole financial crisis, we seized opportunities. We took on more manufacturing and we grew. We added more in the supply chain side towards the raw materials and also in the delivery network. And I can't tell you how important it is to remain financially strong and liquid to be able to seize these opportunities. We became leader in many industries. Unfortunately, competitors closed down during those times, as they're starting to right now. I've had 2 competitors fall on hard times. And at that time, we took over those markets. We differentiated our product line and we grew. We added vertically and horizontally. And we're in the process of doing the same now. It's about being innovative, adapting, and aligning our business accordingly, streamlining processes, reducing debt, and innovating. And by differentiating our product line for different industries, as I discussed before, there are different industries now that are making larger purchases for equipment. So we're actually marketing and differentiating our product line to be able to sell to those industries. So we're trying to stay ahead of the curve. We're adapting. You know, I always say you can have the best team, you can have the best goods and services, but without knowing your audience and market, it will be ineffective. So it's very important that what we do is we research our market by seeing where are the purchases coming from. We also speak to a lot of other executive officers. So we're looking from the end user side. Who's buying? And then we adjust our product and our equipment, and we're in the process of redesigning our equipment to market to these companies. And it's a quick little caveat, little interesting tidbit. And I mentioned this last time we did a space. During COVID, when most businesses were forced to close down in New York, we were the epicenter of COVID, and it was very strict to remain an essential business here. What we did was very creative. We created equipment that was made for was used to make hand sanitizing equipment. So you can bet that our business stayed open full time. And we did not close down at all because we made equipment that companies purchased to make hand sanitizing equipment. So that's just a quick example to show you adaptability, creativity, and thinking out of the box, which is very important. And there are opportunities around us all the time. We just have to be looking for them. And we don't need to force trades or make things happen. Just be patient and remain liquid, and those opportunities will come. There is contraction, and as I discussed, some businesses will fold, but the leaders will emerge, and we will see those. It's challenging, but the leading businesses will adapt, and they will survive, and they'll gain market share and become future leaders. I use the same approach that I've done with I've had multiple businesses, and I use this with long-term investing. And I don't want to toot my own horn like you, Aahan, but I found quite a few great leaders that I have for my long-term holdings. And I base it on the CEO, the business side, the entrepreneur thinking. And my investments have been pretty good. I'm very blessed. I'm very thankful for that. Of course, we all have losers too. But overall, I've been very pleased. So just want to add that there. You know, the pressures on production and employment are increasing. We know that from the business side, and you have that from your data. And we are slowly moving towards an environment of lower output and employment, alongside a backdrop of heightening nominal demand. Sounds like stagflation to me. Aahan, could you please explain that?
Yeah, sure thing. So I think that when it comes to production, I think we outlined the picture fairly well. But so what we've seen on the consumption side is that you have the initial decreases in consumption, and consumers spend into businesses, right? And then that money passes through businesses, through their cost structure, and then to their employees. Now, what we're seeing in those numbers that we track, right, is that about half of all industries that we track in personal income are experiencing negative real wage growth. This is really, really important because the only thing that we're really seeing that is keeping up um, aggregate income is employment growth. So now if I go out and I actually do the math on the attribution of, so wages come, so aggregate wages or employee compensation, they come from either the number of hours worked, the number of people employed, or the wage rate, the prevailing wage rate, right? So you can have any of these three components combined to tell me where real wages are. Now, if I do that attribution, what I can basically see is that the only part that is actually contributing to current wage growth is employment. So employment is actually running at 4% on a year-over-year basis, but aggregate incomes are growing at a 2%. So wages and hours are actually in contractionary territory on a year-over-year basis. Why that's really important is because we are in one of the tightest labor markets ever. And during these times of extremely tight labor markets, you lose the fuel to keep growing labor markets. Now, what we've laid out is a picture of lower output, eventually transitioning into lower production, which will eventually be lower employment. Now, when this employment declines, you're going to start seeing precipitous drops in real growth. And that's a really big problem because we still have nominal growth in an elevated state. The combination of these things will take us into a stagflationary period. Now, what's important about labor is that it's often the last shoe to drop. This is true, and people talk about it being a lagging indicator. But what happens is when labor markets take off, they take off extremely swiftly. So the average move during a contractionary period for labor markets is about 5 times the size of a regular move, which basically means that the speed of the labor market moves during a contractionary period is just immense. So when you hit one of these pockets of labor market weakness, right, it creates a self-reinforcing spiral because the second you remove this worker, you remove his income and you remove his ability to spend on someone else's business. And that's a really big problem. Usually at this point, this is when the Fed comes in and says, okay, don't worry about it. We're going to reduce interest rates. And we're also going to, do maybe QE or something like that. But today, we're in a situation where the Fed's stated objective is actually to worsen the labor market. So for us to get into contractionary territory on a real GDP basis, all we need is a 2% decline in year-over-year employment growth. Remember, we're sitting at 4% right now. So we just need a halving to enter an outright contraction in overall activity. And this is going to come alongside a Fed that isn't going to let up on the pressure. So the combination of these things creates a very difficult environment and difficult set of choices that the Fed will have to make eventually. Because if things play out this way, and they are very much on track to play out this way, you're going to be in a contractionary period with heightened inflation, but with inflation above target, and the Fed not willing to come to the rescue because they have to meet their inflation mandate, and they are willing to sacrifice labor. It's a very, very difficult set of choices. And now what we have to, kind of think about and play out is whether or not this Fed will either choose the labor market or its inflation target. Based off what they've said so far, they're willing to very aggressively pursue their inflation target. This comes alongside massive amounts of quantitative tightening, which are aimed at the purpose of quantitative tightening is to hurt assets. It is to tighten financial conditions, which is to hurt assets. When you combine all of these things, you're headed to a nasty mix where asset prices probably need to be lower for the Fed to achieve its goals. You are going to have high inflation, you're going to have low real output, and employment is going to be in a difficult situation. And at that point, we're going to find out really what the Fed is made of and whether they can continue in the face of a lot of pain, because you're going to be creating asset price pain, you're going to be creating, you're going to be creating unemployment. It's going to be a very big and difficult situation. And the choices they make will determine whether we're going to go back to a 2% inflation world or whether we're going to be in a situation where inflation remains unchecked.
Exactly. Thank you so much. I agree. Yeah, Powell seems to just keep stressing the inflation reduction is number one. He wants to see below trend growth. He wants to see that the imbalance of greater demand than supply of work, the labor force, change. It's too tight. It's too hot of a market. He wants to see it soften. And then he wants to see clear evidence that inflation is going to 2%. And as we see from Cleveland Fed and your data, doesn't look like it's happening anytime soon. So I think they definitely continue with their plan and keep raise those rates and tightening. So that seems to be the plan. I mean, real incomes and spending are weaker. So business sales are also weaker. Real demand's coming down. There's less need for output and workers. So there are employment challenges coming up. And, that's stagflation in this type of slowed growth, high inflation, which we have. And then if we start getting unemployment going up, I mean, once it starts, it's difficult to stop. Highly elevated inflation coupled with slowed growth and now less need for workers. And that's the recipe for stagflation. I want to just ask you a question. It's called a myth. The Mythbusters is a television show. It's like breaking myths. And it just came to me. It's regarding employment and wages. A lot of people say, oh, wages are so high, the highest they've been in a long time. So now people can spend more. There's more money for shopping and more money for spending. And to me, real wages are so far down. Could you please elaborate a little bit on that and break that myth?
Yeah, I mean, I think look, at the end of the day, like I said, we live in a nominal world, right? So what people experience and what they perceive, nobody goes and inflation adjusts their compensation. Maybe they try to build in a clause to inflation adjust their compensation increase every year, but I don't think anybody goes out and says, "Oh yeah, my real income is
So
this much."
funny. I love that. That's funny.
It's so what ends up happening is that when you have these periods of heightened nominal activity, especially when it's business to business nominal activity, we all see prices rising, and what we report to ourselves and to other people is our nominal incomes. So as a result, you do have this kind of phenomena of nominal wages being extremely high and the labor market is extremely tight. So you do have a situation where nominal wages are trying to keep up with the labor market. But the problem is that those wages, due to inflation, they buy less and less. When they buy less and less, you have to produce less and less because your profits are less and less in real terms. And so it's very much an optical illusion in a way, right? Where the perception is that, oh, the economy is strong, but the perception is just a nominal one. Now, even if we look at nominal data, right, we've had a massive deceleration in nominal economic activity. So that's what PMIs are telling you, by the way. PMIs are not inflation adjusted data. Just for reference, they are nominal data. Nobody goes out and asks the PMI survey respondents whether whether your inflation adjusted output has increased or not. They just ask them, how have you made more sales than last year or last month. So I think this phenomena of nominal and real being confused is something that hasn't happened in a really long time, since the 70s. So if you think about the 2010s, nominal and real were basically interchangeable because you had 2% inflation or a little bit less. But now we're in an environment where these two things are moving at highly different levels. So what the Fed really has to do over here is to be able to cause a contraction in nominal income enough to offset all of the excess spending that we're seeing, right? And that's a really hard thing to do given the dynamics we've discussed of there being monetary excesses. So I think, yeah, that nominal wages are extremely elevated, but think about it this way: nominal wages started around 10 to 15% this year. Well, nominal growth started, but at around 10% this year, and since has come down massively, right? So now when we look at, on a rate of change basis, what is happening to nominal activity, it's coming down a lot, but a lot of it is just coming from real activity. So the mix of things is actually changing to be more and more stagflationary. And what we're going to get to is probably a situation where you will continue to have wage growth. Wage growth is not going away, which is good in a way, but is really bad in a lot of ways too. So you probably still have positive wage growth, but none of it will buy you anything new.
Exactly. Thank you so much for busting the myth. You guys all heard it here. So when you hear people saying, oh, workers are getting paid more, we can shop and spend more, there's a big difference between nominal and real. We live in a nominal world, but when it comes to spending, it's about the real. We have to adjust it for inflation. So thank you so much for discussing that. Now we're going to talk about the topic, the big topic, GDP. I see your GDP nowcast continues to show a significant weakening and real growth relative to last year. Real GDP at 1% versus 1 year ago, with inflation running at many multiples of this number. That's horrible, isn't it? Can you please elaborate?
Yeah, so I think in any other state of the world, right? So if you go back to the 2010s where we had roughly, about 2% real growth, maybe 3% real growth, depending on the year. If we were to take that level of GDP growth and we were to impose the level of deceleration we've seen in real GDP growth, it would be one of the worst recessions ever, right? So we started the year tracking at roughly, don't quote me on this particular number, but we were tracking at roughly 6.5% or somewhere around there in terms of real GDP growth starting this year. But we had it in our systems that we were probably going to start decelerating pretty hard for a variety of reasons. And what we've seen is from 6.5, we've come down to 1. That's a 5.5% drop. In any other state of the world, that deceleration would be one of the worst recessions ever. But we have a situation where we were rebounding from COVID, and we have all of these, the spare capacity and potential to come back. So as a result, it's not really a recession. In terms of whether we'll be in a recession or not, the recession is like a formally defined thing that, it's defined by the NBER, the official body, and they go out and look at a set of indicators and essentially try to assess whether we are in a pronounced and pervasive decline in economic activity. And they look at things like industrial production and things like and things like that. So while GDP has declined quite significantly, and we did get 2 quarters of negative GDP back to back, and people were worried about a recession, that number has typically coincided with massive declines in all these other variables. The thing that I think that we're trying to point out is that the deceleration in GDP will eventually get to the point where on a year-over-year basis it's going to be negative. And when we're looking at all these other indicators that go into assessing whether we're going to be in recession, the pressure is on all of them to move into a contractionary kind of territory either as well. So I think that it's just it's a very difficult environment, and we're headed lower.
Thank you for making that point and explaining it. The market and economy, they're always changing. And your data is always changing as well, as the market's changing. What do your systems see as of today?
Are you talking about that from a market perspective, or
whichever you feel, whichever you see, whichever you prefer discussing, market or macro, or what do you see that's going on right now?
Right. So I think there are 2 different angles to this. So what we do broad strokes. We do 2 things, right? I think that there is a very strong interplay that is underappreciated by many people between markets and the economy. So what happens with markets is essentially just what's happening with the balance sheets of the economy, and what happens to the balance sheet of the economy eventually translates into the income and spending in the economy, and vice versa. So you can just think of it as like you would think of a business, and in evaluating a business, you wouldn't look at just its income statement, right? You would look at its balance sheet capacity. And what we're seeing right now, based off our tracking, is essentially this situation where the Fed is going out to create a contraction that is broad-based. We currently are on the slowdowns that we're seeing so far are mostly coming from cyclical slowdowns that are due to these like stagflationary dynamics, as opposed to a lot of pass through coming just from the Fed. What the Fed is really being able to do for markets is it is causing both in present value terms by discounting cash flows at a higher rate. It's causing the present value of all of those cash flows to fall. So asset prices in the economy are falling. On the flip side, it's also creating a contraction in the amount of forward-looking borrowing lending that can happen in the economy. The combination of these things just creates a very, very difficult picture. Now, what we do is we aggregate all of that data up into kind of a fundamental picture, and then we also look at what markets are kind of telling us, right? So what we do is we study the relative movements of asset classes and get a sense of how assets behave in different environments, and we create probabilities of what environment we're in. This entire year, consistent with what we've about repeating, we've been based on our market regime monitor. That's what all this stuff is aggregated into. Our market regime monitor has been telling us that we've been in a period of stagflationary nominal growth. But over the course of the year, the odds of tightening liquidity as a dominant regime have continued to rise more and more. Said differently, we started in a period where nominal growth was just the driving force in all markets. So that's why you had the commodities going crazy and, treasuries kind of selling off, but not as bad as they did. But as this component of tightening liquidity, which is being caused by the Fed primarily, began to take hold more and more, you've had worse and worse outcomes in the market. And that's really the thing. And that contraction in markets in the form of tightening liquidity is eventually going to find its way into the economy, but it takes a while. And you need to cause a significant amount of damage. So to go back to kind of like the start of the conversation, there is no way for the Fed to remove the liquidity that was created by the Treasury. The only person that could really do that is the Treasury, if they came in and they were to increase taxes. But that's not going to happen because of the political climate that we're in. So as a result, the Fed has to go out and it has to contract the monetary system, right? So we can contract either the monetary system by contracting money, or we can do it by contracting asset prices. The Fed is trying to achieve its objective by doing all of the latter. So they're trying to achieve all of this by contracting asset prices viciously. And that's going to be a very hard process. Eventually, it'll hit the economy as well. But the time it takes for it to fully pass through, you could be down a lot more on prices. So broad strokes, that's kind of where, all of our stuff is aggregating to tell us we are.
I was going to ask if anyone had any questions for you. I think we were pretty extensive in our discussion, but if anyone has any questions for any one of us, you could raise your hand. I guess we answered everyone's questions.
Yeah.
Aahan, could you please tell us about the services you offer at Prometheus Research?
Yeah, sure. Thank you. And thanks for having me on again. It was a pleasure. So with regards to Prometheus, we have a free Substack that is available to everyone. So that's I believe that's prometheusresearch.substack.com. We also do a set of bespoke services. So if you're interested in more kind of tailored solutions, you can reach us directly. You can reach me directly at aahan.menon@prometheus-research.com. And yeah, that's kind of what we do. We help people build systematic portfolios depending on their goals. If you're interested in bespoke, otherwise, all our stuff is readily and freely available to all.
Thank you so much. Everything that you do, the services you provide are amazing. Your research is one of my favorite macro reads. And I have to be honest with you, I don't even subscribe to the major subscriptions. I don't read headline news. I want the truth. And I have to say, your research is completely in line with my experiences from my business, and you enlighten me so much. And I hope everyone checks you out at Prometheus Research. Please subscribe to his Substack. It's like a graduate level course in macro. And I've learned so much since I've met you. And I thank you so much for that. Is there anything else you want to add? that we may have missed tonight that you wanted to mention, Aahan?
Nothing in particular. I think that we covered everything. I think everyone here should just go give you a follow. And yeah, that's all I'd like to add.
Thank you so much. As the famous Charlie Munger once said, the best thing a human being can do is help another human being know more. And that is what we hope we accomplish here this evening. Learning and sharing together, we can elevate each other to be better in investing and life. Maintain a growth and positive mindset, believe in yourself, and never give up. Thank you so much for spending this time with me, Aahan, and sharing Prometheus Research with all of us. You are amazing. You are wise beyond your years. I'm so impressed, and you are so brilliant, and I thank you so much.
Hey, thank you. I appreciate that.
And we will meet again soon.
Yeah, absolutely.
Have a great evening, everyone. Thank you so much for joining us the second time as well.
Bye, Rosanna.
Thank you.
Have a good
Bye-bye. Bye. You too. Bye-bye.
Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon.